Vaibhav, thanks so much for speaking with us. Let's begin by understanding what you're making of this, consolidation or correction, whatever it is that you want to call, that we've seen in the markets over the last couple of days.
Yes, I mean, we are definitely seeing that it's a good consolidation period. We have seen about 2.8% correction probably in this month. And we see that it is more because of the global market scenario rather than domestic thing. And especially in global market scenario, I think we are seeing some amount of increased weakness in China, and we may see some amount of demand shock probably coming from there. Also, we are seeing global commodity prices and global currency prices, fluctuate a lot, and they have become volatile. I think because of all these reasons, there is some amount of risk aversion into portfolios, global portfolios, and because of which we are seeing some amount of consolidation in domestic market also.
Vaibhav, does your structural story in the market remain intact over the 1 or 2 year period, or would you take it relook at that the way how the complexion of the market has panned in the last couple of days?
No, we strongly believe that we are in a bull run, definitely, but in that period we will see volatility like what we are witnessing this month, and there are various other variables which are likely to hit the market early next year, throughout the year. Now, starting from quarterly earnings to credit policy rates to interest rates hike in US, there would be various variables hitting, and because of which the volatility would increase. But on an overall basis, point A to point B, I think we would be doing well on equity as an asset class, surely.
Vaibhav, do you see RBI governor turning dovish now? What did you make of the commentary so far, especially in the context of rate cuts coming the next year? What are you factoring in over the next 18 months?
Surely, I think the dovish commentary of RBI policy was a very good welcome. What we anticipate is because of the global commodity prices which are softening, and more so because of oil, the RBI and the government has huge amount of headroom to maneuver around the policy rates. We estimate that the rate cuts will be faster than expected, and at the same time we estimate that in the next 2 years it might be in the tune of about 250 to 275 basis points, which is going to really kick off the financial leverage aspect in the corporate earnings also. So we are definitely very positive on the rate cycle. In terms of the portfolio positioning, we are surely taking cognizance of this, and we would, on a tactical basis, would be overweight on banking and financials, which have an exposure to wholesale funding, and probably or the portfolios, investment portfolios, who have a higher duration with AFS.
Is it time to then start looking at deep cyclicals like, industrial, or are you looking at specific companies?
Okay, so we are extremely bullish on the T&D space, in the sense that what we like is there is going to be huge amount of expenditure or capital expenditure by the government and other various government agencies into improving the whole transmission and distribution network. So we are concentrating on companies who have a technological edge in T&D space. And at the same time who has the ability of getting an operational leverage on the books if their capacity utilization is low, and if their they get in more orders. I think the corporate earnings would really do wonders. That's on the T&D space for sure. And in terms of other industrials, we are positive on whole India story, and industrials is the natural choice of getting into the portfolios.
There's a section of the market that's a little disappointed by the pace of reforms that we've seen so far. Do you believe it's a bit unfair to assess the government in just 6 months?
No, at the outset, let me tell you that we are not at all disappointed with what the government has been doing. We any which ways didn't expect anything to happen, like a bazooka, in the sense that we didn't expect everything to happen in the first 6 months. I think the government is doing a perfect job by laying the broad contours of the areas they want to focus on. They are going to focus on roads, ports, and infrastructure. And we have consciously seen a strategy shift from consumption-driven economy to an investment-led economy. I think this is going to lay the foundation for good growth going forward in next 3 to 5 years. So we are not at all disappointed in the functioning of the government. They are doing at their own pace, but they are doing it in a much better way, in the sense that it's for long term and nothing for a short term. They are doing it on a calibrated basis, which is very welcome.
Vaibhav, my final question to you would be on earnings. The earning momentum so far by the end of second quarter, seem to be on a lower side. By when do you really expect material rise in earnings going forward?
Okay, so I think in the next 2 to 3 quarters, I don't think there is much to happen. But after that, if you see the combined effect of operating leverage and financial leverage, which will come and hit the corporate earnings on the positive side, it would be beyond expectation of any analysts. Against the consensus of about 15 to 17% of earnings growth, I think we estimate that the earnings growth after 4 quarters would be hitting upwards of 20%. And we are extremely bullish, as I said, purely because of the combined effect of operating and financial leverage kicking in once the interest rate starts decreasing. So we are very positive on earnings.
All right, Vaibhav, we'll let you go on that one. Thanks a lot for joining us on the show today with your views on markets.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.